Today, we will try to find an answer to whether CANOO can survive through their annual report. If you take a look, there is a 10K form, which is the annual report dated December 31, 2022. In terms of stock investment, the annual report is the most basic thing that you must read thoroughly as it contains the answers to the questions about the company's operations. From reading the report, it is predicted that there will be significant costs and continuous losses in the near future. They state that they may not be able to control the costs related to operations appropriately. In addition, their business plan requires significant capital, and if they cannot secure enough funds or access capital, it may not be possible to execute their business plan. This could have a significant negative impact on their financial status or operational results. Furthermore, they have significant doubts about their ability to continue as a company from the CANOO management itself, and to survive, they need sufficient additional funds or capital. If they do not have this, they may have to terminate their operations, which means that their listing on NASDAQ may also be terminated. Additionally, various bankruptcies and issues in the financial services industry could negatively impact their financial status and expected business operations, meaning they may not be able to obtain loans or attract capital. Therefore, CANOO has not achieved positive operating cash flow, and considering the expected capital demand, their ability to generate positive cash flow is uncertain. Due to their limited operating history, evaluating their business and future prospects is difficult, and investment risks increase. If they do not manage their growth effectively, they may not be able to successfully design, develop, manufacture, sell, and launch their EV. CANOO heavily relies on key employees and top management services, and their competitiveness may be damaged if they cannot attract and retain key employees or hire qualified management, technical, and engineering staff. They are facing significant barriers to manufacturing and launching EVs into the market, and if they cannot successfully overcome these barriers, it will have a negative impact on their business. They have committed to purchasing a significant number of vehicles, but it is unclear if they will be able to sell them. Let's start by looking at the assets balance sheets. There are assets, including current assets, non-current assets, and fixed assets. That's how you should view it. Currently, the most important thing in CANOO is assets. In other words, the amount of money in current assets is the most important. That's what we can say. So, if you look at the table, cash and cash equivalents, which is the amount of cash, is $36,598. That was in 2022, and in 2021 it was $224,721, which decreased to about $36,000. So, in other words, there's almost no money left, right? Then, even if we add up other current assets, such as restricted cash or prepaid, it only amounts to about $50,000. Because there is nothing else, it's almost like a bankrupt state. You should see it this way. So, you can see that assets have decreased significantly. When there is a decrease in assets, it means that there has been a significant decrease in cash. Current assets have really decreased a lot. That's what we can say for now about the current item. Let's take a look at liabilities and stockholders' equity. Firstly, there are current liabilities and non-current liabilities within liabilities. Looking at liabilities overall, it represents the money that needs to be paid back, and it has increased significantly from $50,000 to $103,000. This means that the debt has increased a lot. The total current liabilities are now $218,000, which is much higher than last year's $136,000. As a result, the liabilities have increased significantly. Moreover, the current assets have decreased significantly. Therefore, if the assets have decreased, and the debt has increased, it means that the equity has decreased substantially. Consequently, we are currently looking at an unfavorable balance sheet. Assets have decreased, and debt has increased, resulting in a slight decrease in equity. Therefore, the current annual report is consistent with what we have observed in the balance sheet. Let's take a look at the income statement. When you look at the income statement, you can see the section related to revenue. The loss from operation is related to revenue, so it is shown above the line. Therefore, the line above is the most important, as it is related to revenue. The lines below are below the line, which means they represent revenue or loss that is not related to revenue. So when you look at it, there is no revenue at all. Next, the research and development expenses increased from $200,000 to $290,000. This is likely to continue to increase every year. Therefore, The loss from operation is showing a vicious cycle where only operating expenses continue to increase, with no revenue. Another thing to check is other income, expense, where the interest expense itself has increased slightly in 2021, but now in 2022, the interest expense itself is actually negative. The contingent earnout shares liability has also decreased significantly. Another thing to note is stocks. The number of stocks available on the market has increased from $220,000 to $260,000. However, with the continued increase in losses, this is not a good sign, and it is reflected in the income statement. Therefore, the deficit is deepening, and there is no profit appearing financial state. This can be summarized in one sentence. Next, let's talk about cash flows. Cash flows are the most important thing. The financial statement we look at first is the cash flow statement. Once we know how cash is flowing, we can analyze the income statement or balance sheet more deeply. There are three types of cash flows: operating, sales, and investment activities. Through these three, we can generate cash flows. The most important of these is operating activities, which is how much revenue we generate through selling goods or services. Sales and investment activities are not as important. In the beginning, financial activities, such as selling stocks or bonds to raise funds, are important. Later, we focus more on business activities. For example, in the case of CANOO, operating activities were negative $300,000 in 2021, but negative $400,000 in 2022. They are spending more money on operating expenses than they are earning. This matches with the decreased profits on the income statement. Investment activities are good if there are a lot of equipment investments. This is because we can generate profits by investing more. As we can see in the table, in 2021, the investment activity was negative $162,000, but it decreased to negative $66,000 now, and equipment investment has also decreased significantly. Finally, financial activities. In 2021, it was almost non-existent at negative $11,000. But it has increased to negative $290,000, indicating that they are raising funds through financing activities. This is considerably high, and there is almost no investment activity. It means they are only raising money by selling stocks. Therefore, the company's financial situation is not very good. The most important thing is cash equivalents. If we look at the cash, it was only $700,000 at the beginning of 2021, but it decreased by about 3 times to $220,000 by the end of the year. Now in 2022, there is only $50,000 left. As you saw on the balance sheet earlier, the company is in a very difficult situation. Even so, if you want to invest, be careful. I don't think it's the right time to invest. Subscriptions and likes give me a lot of encouragement. Thank you.